Hello everyone. Welcome to yet another critical session on goods and service tax filings. Today, we are going to learn about the reconciliation of GST returns with the sales register and purchase register. In this session, we will cover the importance of reconciliation, then the document mapping, then the step-by-step reconciliation process and the tools that are available for such reconciliation and the corrections that can be made in the returns and the books. So before we proceed, let us see what we did in our previous session. So in our previous session, we learned about the matching of GSTR 1, GSTR 3B and GSTR 2B. We studied how to download the returns from the portal and check the downloaded returns that they match with each other. Then we learned about the tools that are available for matching of returns like Excel reconciliation sheets or GSTI and utilities, then accounting software and so on. So let us now proceed with today's session. So why reconciliation is essential? It ensures that taxes paid matches with the actual business record and avoid the mismatches and notices from the GST department. It also helps in maintaining a clean set of books of accounts. So what is a reconciliation statement and why it matters? So GST reconciliation means comparing the data filed in our GST return with our accounting records. Accounting records like sales register and purchase register. So why is it important to reconcile the data? It ensures taxes are paid on actual basis. Then it helps to avoid the excess or short claim of input tax credit. Then it also helps to detect errors like duplicate invoices or missed entries. And it also helps to maintain clean books and comply with the audit requirements. So if the reconciliation is not done properly and that too on time, then it may lead to rejection of input tax credit by the department and imposition of demands and penalties. It may also lead to issuance of notices by the GST department, and also it will lead to filing of inaccurate GSTR 9, that is the annual return for the taxpayer. So GSTN matches our file data with our vendors and customers. So internal accuracy is the first step. So proceeding further, what are the key documents that are involved for reconciliation? First one is sales register. It is a book record of our outward supplies including invoice numbers, date, value and tax along with recipient GSTIN. Then purchase register. It is a book record of inward supplies, that is expense and purchases including invoice wise GST details. Then GSTR1 filed on monthly or quarterly basis contains the outward supply data. Then GSTR3B, it is the summary return that shows the tax liability and input tax credit claims. And GSTR2B data, it is a auto drafted input tax credit statement generated from the supplier's GSTR1 return. So we reconcile the books with the GSTR1 for reconciling sales, then GSTR3B for reconciling the tax payment and input tax credit claims, and GSTR2B for vendor uploaded purchases invoices. So let us see the reconciliation of sales register with GSTR1 and GSTR3B. So the objective of reconciling the sales register with GSTR1 and GSTR3B is to ensure that the outward supplies recorded in the sales register matches with the details as per GSTR1 and the tax liability as reported in GSTR3B return. So to reconcile these set of data, we have to first export our sales register for the month. Then we have to download the GSTR1 summary from the GST portal. This we have learned in our previous session. Then we have to compare the taxable values, GST rates and the GST amount invoice wise. And finally, we have to check that the GSTR1 values are consistent with the GSTR3B values contained in table 3.1a, that is outward taxable supplies. So during the reconciliation process, we have to check for the missing invoices, then incorrect GSTIN or tax rates, then invoice uploaded with incorrect amounts and GSTR1 file but taxes has not been paid in GSTR3B return. So these could be the reasons for differences in the values as per books and returns. So if differences are observed, then we can use the GSTR1 amendment feature in the subsequent period return to rectify any error or any mismatches and adjust the tax liability in the GSTR3B if it has not been paid yet. So next is reconciling purchase register with GSTR2B and 3B. So the objective to reconcile purchase register with GSTR2B and GSTR3B is to ensure that the input tax credit claimed in GSTR3B is supported with eligible invoices in purchase register and are appearing in our GSTR2B. For the reconciliation, we have to export the purchase register from our books of accounts. Then we have to download the GSTR2B from the GST portal. Then we have to match the invoice wise data, that is supplier GSTIN, invoice number, invoice date and the input tax credit amount. Then we have to compare the table 4A of GSTR3B, that is the table for input tax credit claimed. So there could be reasons for differences like supplier did not upload the invoice in GSTR1 or duplicate or missed invoices or incorrect GSTIN or invoice date or ITC claimed on blocked credits like motor vehicles or personal expenses. So the reasons for such mismatches can be avoided by not claiming input tax credit until it is reflecting in our GSTR2B, then regular follow-up with the vendors for corrections and use internal approvals for control of vendor invoices. So what are the tools and formats for reconciliations? Excel based reconciliation. So create pivot tables with invoice numbers, GSTIN, taxable values and tax amount for cross-checking of these parameters. Then accounting software integration like Tally, Zoho, ClearTax reconciliation tools and other third-party apps that are available for reconciliations. Then automated matchers. Some portals offer auto matching tools to import GST files and compare with the books. So it is very important to reconcile the all set of data on a monthly basis, use HSN and invoice matching and maintain supporting documents for each of the reconciliations. Audit trail and rectification. So as per section 35 subsection 5 of CGST Act, businesses with turnover exceeding rupees 5 crores must file a reconciliation statement along with their annual return. So it is imperative to keep a proper audit trail of reconciliation files, vendor communications and any amended records. So their mistakes can be rectified through GSTR1 amendments or debit notes and credit notes, then through vendor corrections and at last it can be rectified through the annual return adjustment that too with a proper caution. So, to support accurate reconciliation and safeguard against security, business must maintain a clear and verifiable audit trail. Such audit trail includes reconciliation files. These are the internal working files that match the turnover, taxes paid, input tax credit claim, and the liabilities that have been declared in GST returns with books of accounts. Then vendor communication, any follow-up emails or documentation with the supplier regarding mismatches in invoices, GSTIN errors or incorrect tax amount must be properly recorded. This can be critical during the reconciliation, especially for input tax credit mismatches. Then amendment records. The taxpayer should track all the amendments made to the previous return, example GSTR 1 corrections or GSTR 3B amendments. Document the reason for changes and the corresponding financial impact of such changes on the financial statements. So to ensure the accurate reporting and avoid discrepancies between the financial statement and GST returns, the mismatches can be rectified through GSTR 1 amendments. So if the outward supply details were reported incorrectly, such as wrong GSTIN of recipient or incorrect invoice values or tax amounts, they can be amended in the subsequent period's GSTR 1 return. Then through debit notes and credit notes, these can be issued to adjust the taxable values or tax amount in case of post-sale price revision or product returns or error in invoicing. Then vendor connections. Follow up with suppliers to amend the GSTR 1 filings if their reporting has errors. Example, invoice not reflecting in our GSTR 2A or 2B. This is essential to claim the input tax credit correctly. Then finally, the annual return adjustment. Minor adjustments and reconciliations may be done in the annual return, that is in GSTR 9. However, these should be made with care and clear justification, as these returns consolidates the entire year's transaction and forms the basis of final compliance. So it is imperative to ensure that the books of accounts GSTR 3B, GSTR 1, GSTR 2B and GSTR 9 are in sync. Mismatches can trigger notices, audits and denial of input tax credit. So it's always a good practice to complete the quarterly reconciliations rather than waiting for the year-end adjustments. So moving ahead. So to conclude, reconciliation ensures accuracy, compliance and peace of mind. It matches data and ensures mismatches have been rectified in the subsequent period return or if required in the books of accounts. And it is always advisable to avoid the backdated claims and mismatches. So before we conclude with this session, let us see a sample of reconciliation statement between GSTR 3B and 2A and books and GSTR 2A. Here, so this is the reconciliation of books and 2A input tax credit. So this is the total purchases as per the books. This is the taxable value, IGST, CGST and SGST. So purchases as per tally is 61,12,627. Corresponding taxes are 163,580.74, 434,849.24 and 434,849.24 under the state and the central head. Then we have added the purchases in GSTR 2A but not in tally. That is, these invoices are appearing in our GSTR 2A or 2B but have not been accounted for in our books of accounts. So these pertains to us. Taxable value is 2,70,088 rupees 50 paise and corresponding GST is 186.39. 24,109.56, 24,109.56. Then purchases in tally but not in GSTR 2A or 2B. So these invoices have been booked in our books of accounts, but the suppliers have not filed their GSTR 1 return or have incorrectly entered our GSTIN in their GSTR 1 return, due to which these are not appearing in our GSTR 2A or 2B. So this is 2,42,609 rupees is the taxable value, against which input tax credit is 1800 in under the IGST, 20,934.74 under CGST and same amount under SGST. So we have arrived to the purchases as per our GSTR 2A register, that is 61,40,106.60, and the corresponding taxes are 1,61,967.13 and 438,024.06 under center and state heads. So this should have been the purchases as per GSTR 2A as per our reconciliation, but the actual amount is a little different. This could be due to rounding off effect. So this is the reconciliation between the books and the GSTR 2A. Then this is the reconciliation between the GSTR 2A and the ITC claimed, that is GSTR 3B. Here we have total ITC claimed during the year is 162,008.67 under IGST and 399,810.56 under CGST and SGST. So this input tax credit have been claimed in GSTR 3B. Less ITC of previous year, that is financial year 18-19, claimed during the year. These input tax credits that have been claimed during the year pertains to the previous year. So we have deducted this. Then the net ITC for the year was this much, that is 159,407.67 under IGST, 394,982.06 under CGST and 394,982.06 under SGST. Then ITC short considered in GSTR 3B. Some input tax credits were not taken in GSTR 3B. So we have added these. It means these inputs were appearing in our GSTR 2A, which have not been considered in the 3B. Then ITC reversed in 3B but not in tally. So few input tax credits were ineligible. So we have reversed these in the GSTR 3B return, but the reversal entry in tally has not been done. So the ITC, we have arrived to the ITC as per books. So this is the ITC as per the books that should have been as per the reconciliation statement, but the actual ITC as per the books was a little different. Again, this could be due to rounding off effect. So this is how the reconciliations are to be made and kept under record. So let's conclude the topic. That was it in this module. Thank you.